Good evening, ladies and gentlemen. Welcome to this webinar of MeritorQ Advisory Portfolio. I am Alok Nangalia and I am part of the Client Advisory and Relationships team. I have with me Krishnan, who heads the research function for our quant offering, MeritorQ. The agenda for today's discussion is to understand why the portfolio size of 30 to 45 companies combined with semi-annual rebalancing benefits the investors from the available investment opportunities. Why MeritorQ, which is a rule-based strategy, is better positioned to take advantage of such opportunities while keeping the turnover in control. How we resolve the concentration versus diversification debate in MeritorQ, and why a rules-based strategy need not be concentrated to get the optimum results out of it. Once Krishnan completes the presentation, we will have the Q&A session. You can type in your questions in the box on your screen anytime during the course of this webinar, and we will try and answer as many as possible post the presentation. With this, I will request Krishnan to take us to the presentation. Over to you, Krishnan.
Thank you, Alok. A very good evening to everyone who has joined us. Welcome to this webinar. It's an interesting topic because we generally get a lot of questions based on our the interactions we have had on the size of the portfolio in MeritorQ, right? Why does it have 30 to 45 stocks? So this webinar we will discuss this topic. So before we move on to the content for today's presentation, please do note our usual disclaimers, which is investment in securities are subject to market risk. You should read all scheme-related documents carefully before investing, and all the figures, return figures or otherwise, which we have, which we'll be showing in the subsequent slides, are for illustration and understanding only, and do not guarantee any future returns. So, just maybe a quick detour of the investment rules we have discussed on MeritorQ, essentially the checklist, if you remember. So in MeritorQ, again, we are starting with the large, mid, and small cap stocks, which is your top 500 stocks in India in terms of market cap, equivalent to the BSE 500 or the Nifty 500 investment universe. From this universe, we remove companies which don't meet our accounting screen, or essentially our forensic screen, i.e. these are companies which don't have clean accounts. So we remove these companies. So we remove around 200 odd companies, and from the remaining 300 companies, again, we look for companies with high leverage or inconsistent profitability. Even these are removed. Again, as we have discussed before, the primary function of this screening step is to avoid well-destroying companies and reduce the overall risk of the portfolio. After screening, we select 30 to 45 stocks, which are both profitable as well as undervalued. And this we do at each rebalance, in the first trading date of April and October. Again, the rebalance dates are also fixed, right? So this is the portfolio construction process, again, which we have explained multiple times before in MeritorQ. Finally, the final portfolio which we have, the companies are, the allocation is such that the more undervalued the company is, the higher allocation it gets in the final portfolio, right? And our definition of undervaluation is, again, like we have discussed before, is based on free cash flow. So we compare the current price of the stock versus the free cash flow when we go through the entire portfolio construction process. So these are all the steps, and starting from the 500 stock investment universe, these end up with around 30 to 45 companies, and this is precisely what we have tried to show in the final chart on the left here, right? But over the years, right, there are two main approaches that have evolved in active management, right? So, again, one way, on one end, there is, you can call what is called as quant investing or systematic investing. On the other side, there is the discretionary investing where, a human being or a fund manager or, with a team of analysts, they are, analyzing companies and, again, picking stocks, right? again, how is this systematic approach or the quant approach which we follow in MeritorQ, or the checklist approach, as we like to call it, how is it different from a discretionary investing approach? To put it simply, quant strategies basically they apply a more repeatable and data-driven approach, relying on computers to identify investment opportunities across many securities. In contrast, a discretionary approach involves in-depth analysis across a smaller number of securities, and also on information that is not easily available. So you might go and talk to the company's management, you might go and talk to the supply chain of the company, right? The consumers or the producers, who are linked to the company. So so that's the basic difference, right? Systematic investing or quant investing, because it relies on data, it requires longer data histories, right? And liquid markets. And usually the best opportunities for quant investing arise when obviously in the markets are not only liquid, but they have reasonable history, but they're also maturing, right? And this is probably the point where Indian markets are probably at this point. You can argue one way or the other, but at least according to me, I feel this is an ideal time for quant investing in India, right? So there's another confusion on how is quant investing different from passive investing, and is it actually active or not, right? Now systematic investing or quant investing strategies are active strategies because they involve high turnover, limited capacity. They might involve timing, and usually they employ proprietary signals, right, or signals which have been created by the fund management team or the team involved. And this is not again so that's very different from passive investing, right? So passive investing is basically again, the pure passive investor is the person who is invested in market cap weighted indices, right? Because it's completely buy and hold. And each investor can hold these portfolios, the ETF or the passive portfolio without any need for rebalance, as the portfolio weightages they reflect a market cap weighting at any point in time. So you don't need to rebalance at any given point in time. You hold these portfolios, the weightages reflect the market cap weighting automatically, right? Passive investing in equities aims to capture long-term equity risk premium, right, with very low turnover and very good liquidity and very large investment capacity, right? So you can invest a lot of money, right, without worrying too much about trading cost or churn, right? In contrast, when you think about quant strategies, they basically they move away from this market, the neutral market cap or the market cap weighting, starting point. As such, they represent an active view. So essentially, for example, if you think in MeritorQ, we have taken a set of steps, right, which we think would improve the long-term risk-adjusted return for any investor, right? Our screening steps and final selection steps, and even the final weightages. Again, this is based on price to free cash flow, where we are giving higher weightages to more undervalued companies, right? So again, this is an active decision, right? So which is again based on our own research and the way we understand what might work in long run for long-term investors in India. So again, just to clarify, quant investing is not same as passive investing, and quant strategies they are actually active, right? So just to clarify, right? So and in spite of again this growing popularity of quant managers, there are still a number of misconceptions about them. The most common misconception is they employ black box technique, right? Created by machines, or machine learning is the buzzword nowadays, without any human insights, right? They are boring because they lack diversification, they lack good stories, and they all do the same thing, right? But that's not the case, right? As you have explained multiple times in MeritorQ, quant investing, again, the approach we have taken here, it's completely transparent. Again, even though it's rules based, we have explained every step in the process, how we have arrived at those steps, and how they add value for long-term investors, right? So while quantitative and discretionary approaches, one might say they are mutually exclusive, the fundamental and quant approaches, they need not be mutually exclusive, right? In fact, in the very next slide, we'll highlight the similarities between fundamental and a quant approach. So when we say a fundamental approach, essentially, we are let's take an example, right? So you can think about a fund manager. It could be a normal, a discretionary fund manager who is looking to, buy undervalued companies, right? Or essentially companies that trade for less than what they are worth. So this fund manager would then look for companies, which are, again, when they say cheap, essentially cheap versus what they are worth, right? So that what they are worth is essentially the present value of the future cash flows, basically the free cash flow generation ability, their profitability, their future business prospect. And obviously, in many cases, the fund managers also look for not just undervalued companies, but they're also looking for undervalued companies with some catalyst. Essentially, whether they have a potential future event that could change the business prospect. Or in many cases, fund manager could be looking at companies with resilient business model, right? Again, when you think about quant strategies, how they would approach this is cheap fund manager who's looking at cheap companies, a systematic factor, or what we call a factor in quant investing, it would be value, right? Similarly, when we say with some catalyst, essentially you're looking at companies or whose price or their earnings have momentum, right? So that is again one way of thinking, right? Of when we say what are the similarities, right? Essentially, if you think about it, the underlying theme is exactly the same, right? So you're looking at identifying either cheap stocks or those with catalyst, or with sound accounting practices, and obviously trustworthy management, right? Now, the same things you can achieve on the quant side, using again commonly known factors, and obviously using unconventional or other approaches, right? For example, identifying trustworthy management, right? So the fund manager would go and speak to the company's management to evaluate the quality of the management, or have interactions with, again, like I said, the stakeholders, or multiple stakeholders of the company, the employees of the company, the management of the company. Another way, the same thing can be achieved by a quant manager is, so they can, do a textual analysis of the management commentary, for example, right? They can analyze changes in the corporate policies. They can look at the insider trades, the company's stock. The key here is just the lexicon, right? What a discretionary manager might call a thematic approach, a systematic process call a factor-based approach, right? Or a quant approach. And again, we have highlighted, this multiple similarities, right, on various dimensions. But just to add, in MeritorQ, at least the factors we are focused on is value, as we have repeatedly said, again, but not any undervalued company, but undervalued companies which are profitable, and those which are stable, right? When we say stability, which are safe, both in terms of their the stability of their earnings, they're not cyclical, and also which are not leveraged, right? So their debt is under control, right? And obviously, we are also screening out companies which have poor accounting quality through our forensic screen. And finally, even though we don't evaluate management directly, like we have said before, at least in the live portfolio, we do take a look at the final portfolio, right? And if we find any companies in the final portfolio which don't meet, in which we as a firm, we are not comfortable investing in, if we have any corporate governance concern, then essentially that company is removed manually. So again, that's one way for us to express the very last point here. Even though it's not done in a quantitative fashion or in a rules-based fashion, it is still part of our portfolio construction process. So, before we jump on, to the benefit of, why a diversified portfolio or a large portfolio is beneficial, right? Especially for, a quantitative investing approach we follow in MeritorQ. First, let's take a look at why a diversified portfolio of stocks is better than a single stock, right? It's a very simple example we have taken, but hopefully, this gets the point across, right? So just consider a very simple case of a two-stock portfolio, right? We invest 200 rupees in this portfolio with 100 rupees equally in each stock A and stock B, and wait for 5 years, right? Now, suppose stock B during this 5 years, it goes bankrupt, right? Essentially, the company goes, assume that it goes bankrupt and the share price goes to zero, right? So your returns are minus 100%, right? For stock B, and stock A goes to 500, right? If you do a simple calculation, so you start by investing 200 rupees, right? But at the end of 5 years, you're left with 500 rupees, all in stock A, right? A simple calculation will tell you that you would have earned 20% per annum, approximately 20% per annum over these 5 years, which is still quite decent, right? Because you would have still beaten inflation and done better than market cap, indices or any benchmark out there, which again attests to this power of diversification. So what has happened is, even though one of your investment has failed, right? Out of two investment in which you had say equal conviction, one of them has failed because of you're holding a diversified portfolio. Essentially, you're not put all your eggs in one basket. What that has allowed you to do is still earn decent returns, on your investment. Obviously, again, this is just a stylistic example. This has very little relation actually with what we do in MeritorQ, because our screening and selection steps in MeritorQ, again, what we have heard repeatedly, they ensure that the chance of picking any such company like stock B, which which can end up being bankrupt, is extremely low, right? But again, this example was just to illustrate why a portfolio of stocks is investing in a portfolio of stocks is more prudent than investing in a single stock. Now, like we said, right? In slide 4, we talked about the difference between discretionary and systematic managers. Discretionary managers tend to spend, like we said, a considerable amount of time just learning more about a handful of companies. So basically, they follow a best ideas, essentially kicking the tires approach, where you just focus on maybe 30 to 40 companies and select the best ideas portfolio from this subset. So essentially, you have ability to build a very concentrated portfolio, right? In contrast, a systematic manager or a quant manager typically evaluates every stock in the investment universe over, again, a very large investment universe, right? Over hundreds of companies, and a repeatable process. Again, because the quant process, by definition, is more efficient because it's again machine driven. It allows us to have much greater depth, much greater breadth, right? So depth is more easy for discretionary managers to depth in individual stocks, or building knowledge on individual stocks is much more easy for discretionary managers. Breadth, or able to analyze across a large number of securities or applying the same ideas across many stocks, that is an advantage for a quantitative investing process. So this is an advantage if ideas are repeatable and effective, right? Applying good idea which has worked well over different time horizon, other countries, and avoiding bad investments, as we have done in MeritorQ. So you come up with those set of rules and apply these to as many investment opportunities to improve investment outcomes, right? Now, again, we have just shown this, again, taking a very stylistic example and comparing, just to take an example, this compared a concentrated manager with a discretionary manager, right? A concentrated manager could again be, again, this is more related to a discretionary manager, but think about a concentrated manager just holding 10 stocks, right? And we have compared what is the accuracy, right, or the accuracy of the prediction that manager has to have, or a success rate that manager needs to have to be comparable or be as successful as a quant manager who's holding more stocks, right? So so a fund manager who's selected stocks or have a higher probability of outperforming, what we call as hit rate, is on an average, consider a fund manager whose selected stock have a hit rate of 53%, right? So this is better than a random coin toss, right? Here we are evaluating portfolio success based on the probability that more than half of the stocks in the portfolio outperform, right? So that is our criteria for success, which we are showing here on this diagram on the x-axis, right? On the y-axis, we are showing what is your accuracy rate or your accuracy you need to have to select the outperforming stock, right? So in a way, your y-axis, you can think of it as a barometer of your skill, right? Whereas your x-axis, you can say it's your success, right? What is the probability that more than half of the stock that manager will choose will end up outperforming, right? So, and what we are showing in this diagram is, essentially, as the starting with just 10 stocks, right? You can see that if both the quant as well as the the discretionary manager with just 10 stocks, if they start with 53%, both of them have 53% hit rate, right? So both of them will have similar success, or probability of success, right? But as the quant manager, increases the number of stocks in their portfolio to 30 stocks, right? Now the concentrated manager with holding just 10 stocks essentially needs to now improve their accuracy, right, or their ability to predict the outperforming stock, right, to the outperformance hit rate, right, has to now improve to 57%, right? So essentially they need to now become more skilled to match the success rate of a quant manager who's now holding 30 stocks, right? So 10 stock manager has to now become more skillful to match the success rate of a quant manager with just 53% hit rate, but now holding 30 stocks, right? And if you now take this example to the extreme, right? So what happens if the quant manager now holds 100 stocks, right? So essentially that means that the discretionary or the concentrated manager with just 10 stocks now needs to improve your accuracy level to 62%, right, to match the success rate of a quant manager holding 100 stocks, but with just a 53% accuracy rate, right? So this whatever we've shown in this illustration is basically very stylistic, right? Essentially, we have made a number of assumptions, and we are not assuming any transaction cost, so on and so forth, no friction. But just to again highlight this importance of why having a large number of having a larger portfolio is uniquely suited for a systematic or a quant investing process, because like I said, right, because quant process tends to be very efficient at evaluating a large number of securities, right? Even though you might at individual stock level, your skill or your accuracy, it just needs to be, even if it is better, slightly better than a random coin toss, slightly better than say 50%. Even then, having a larger portfolio, can give you a significantly higher portfolio success rate, where you would be able to match the skill level of say a more skilled discretionary manager, right? So this is the importance of the size in quantitative investing approach. Again, like he said, again, quantitative strategies are more efficient. It's more efficient for them to increase the breadth of investment opportunities, hence the larger breadth, loosely translated into larger portfolio size and frequent rebalancing is an advantage for quant managers rather than a handicap, as long as the returns can survive transaction costs. Again, this is a very important caveat. Obviously you can increase your go on increasing your portfolio size, or you can keep on rebalancing as often as possible, but again the transaction costs become prohibitive, right? So again, this can only be done to a limit, and the returns have to survive the transaction cost. And also remember again, the stock picks shouldn't be correlated, right? Again, that's also a very important caveat here. Now, having said all this, you might come to the conclusion that quant managers have an advantage all the time, right? I mean, you can just build a big portfolio and just keep on doing what you're doing and just rebalance as often as possible, and no discretionary manager would be able to beat you. But that's not the case, because some active discretionary managers, obviously they have their own. They are very skillful, right? They're able to predict, or what's going to happen going forward, or predict the expected returns of stocks well in advance. And obviously there are also other advantages, right? So for example, discretionary managers can position size with more independently, right, based on their high conviction ideas, right? So for example, if they know which stock is going to has the highest expected return, they can appropriately overweight those stocks, and basically let the conviction reflect on the portfolio, through the portfolio sizing, by running the winners and cutting down on the losers. And also, again, discretionary managers also have ability to use non-quantifiable information, non-quantifiable forward-looking information, among others. Obviously, forward-looking information comes with its own biases, that comes with its own judgment. But like I said, right, this is where skillful managers can make a difference, right? So, just to highlight, this point on, why breadth is important for quant managers. In fact, there's a well-known relationship in finance called fundamental law of active management, right? It states that the excess risk-adjusted return increases with skill, right? Essentially, the skill here is the hit rate, somewhat very loosely connected with the hit rate, which we talked about in the previous slide. And the square root of the breadth, right? Here, what we mean by breadth is essentially the number of independent bets or the number of independent trials. Again, the key here is independent, right? So, or uncorrelated, right? So, so if your independent bets in a given year in any strategy, it goes up by 4 times, say by increasing your rebalancing frequency by 2 times and doubling your portfolio size. What this means is, relationship means is, your excess risk-adjusted return that can almost double, right? Again, please note that again, this relationship is approximate, and it's the an ideal. It assumes no transaction cost, etc. So there are a lot of idealizations built into it. But so the actual realized benefit could be potentially be lower. But again, the point being that the more the breadth, right? The breadth could either be in terms of the portfolio size, essentially the number of stocks in the portfolio, or the number of rebalances, the better off you are, in a quantitative strategy to maximize your risk-adjusted return. Okay, so now why do we select? Again, for people who are following this, the arguments we have made, till the last slide. Obvious question would be, why do we select then, just 30 to 40 stocks? Why not select, the full 500 stocks, or just go for the maximum number of stocks possible, right? Now, before we get into that, let's recall that the investment universe in MeritorQ is restricted to the top 500 stocks in India, equivalent to the Nifty 500 or the ASI 500 index, like we said. One of the reasons we decide, we restricted the investment universe to this set was the trading liquidity in Indian markets, drops rapidly, even beyond the, the largest 200, 250 names, right? As discussed, again in our previous webinars also, the screening steps, right? The pre-screening steps which we have in MeritorQ, starting from the investment universe, they are necessary and in fact essential to avoid investing in well destroyers, right? Where you can have permanent loss of capital. And so this would be stocks with very low hit rate or likelihood of future outperformance. So, so screening steps are essential and obviously we can't our investment universe can't be beyond the top 500 stocks, right? So that is essentially the limitation, right? So in MeritorQ, our selection, or the universe on which we do the selection, essentially the 80 to 90 companies which are left after the screening from the top 500 stocks, right? So this is around 80 to 90 companies, which we have said before. And essentially on this, we pick profitable and undervalued companies, which further tilts the odds of outperformance, right? Now, to coming back again to the key question, why don't we select more stocks or rebalance more often in MeritorQ? The reason simply is it will dilute portfolio quality, because again we can't get rid of we can't increase the investment universe, nor can we get rid of the screening steps, right? So essentially we have to work with the 80 to 90 stocks, the post screen universe which we have. And if we now select, say, more than 40 stocks out of 80 to 90 stocks, essentially you are now selecting stocks which are worse than your average stock among the screened universe, average stock on both valuation as well as quality, right? So you definitely don't want to go down the you don't want to dilute the effectiveness of the valuation as well as the profitability of the selection step by going down below the 40th best stock, right? Because your screen universe itself is only 80 to 90 stocks, remember, right? And obviously, the reason we can't rebalance too often is because, like we've discussed in the previous webinar, more frequent rebalancing leads to more churn, hence more transaction costs for investors. So monthly rebalancing would have more churn than quarterly, which in turn would have higher churn than semi-annual, and so on and so forth, right? And as we have shown previously, semi-annual rebalancing allows us to strike the ideal trade-off between churn and risk-adjusted return, right? So what the bar chart, what we are trying to show on this slide, emphasizes this point, right? Here we are showing 3-year rolling returns for MeritorQ for different portfolio size. Essentially we are selecting 19 to 25 stocks. When you think about the bar on the left, and as you go from left to right, we are picking more and more stocks, right? And the rightmost portfolio essentially is your full screened universe. So that's why we are saying the selection ratio that is 90 or 100%, and the size of the portfolio is 90. So you're picking all the stocks which have cleared our screening steps, but we are not doing any selection for the bar on the rightmost bar, right? And what this tells you is the 3-year rolling returns. Again, all these return numbers, please note that these are before transaction costs, and again we have averaged these numbers by over a 16-year period from July 2006 to September 2022. So what this shows is the 19 to 25 stock portfolio as well as the 30 to 40 stock portfolio delivers the best 3-year rolling returns, right? 22.5%. And especially note that a 30 to 40 stock portfolio, when that has a 40% selection ratio, which, like I said, allows you to pick, the stock which has better valuation and profitability versus an average stock in your post-screen universe, right? Now, essentially, what this means is, again, we'll discuss, on the next slide, how the risk-adjusted returns and the turnover looks like. But essentially, what this means is, the Meritor's checklist of investment rules. It basically filters out the investment universe to a set of stocks with the best odds of future outperformance. And the portfolio size in MeritorQ of 30 to 45 stocks, along with the semi-annual rebalancing frequency, allows investors to benefit from the breadth of investment opportunities while keeping the portfolio churn under control. Now, this slide again shows what we talked about in the previous slide, but with more clarity, because here you can see that again the returns of the 1925 stock portfolio and a 30 to 40 stock portfolio is comparable. But what this slide shows you is it shows again the risk-adjusted return, right? So the red line basically shows the average 3-year rolling returns divided by risk. So higher the number, better it is. Essentially, it means that how much returns the strategy is earning on a 3-year basis for every unit of risk, right? So higher the number, better it is. And you can see that that red line that gets maximized, for a 30 to 40 stock portfolio, right? And as your portfolio size, increases from 13 to 18 stocks to 90, as you go from left to right, your turnover, which is represented by your blue line, that steadily comes down, right? Now that's also, in a way expected, but I'll come to that later. So again, the point being that again, that MeritorQ's, the 30 to 40 stock, the choice for 30 to 40 stock portfolio, as well as the semi-annual rebalancing, allows you to basically capture this, the ideal point of your risk-adjusted return while keeping the turnover under control. Now, another advantage of picking a larger portfolio is that reduces allocation to a single stock or a set of stocks, hence reducing chance of a concentrated position in either in a single stock, right? So concentrated position in a single stock is not good, because it can lead to higher drawdowns. Now, this slide shows you the average and the maximum allocation to any single stock across the backtest, right? So again, we have shown these numbers, these allocations for different portfolio sizes. Note that these allocations are again based on position sizing on the free cash flow ratio, right? So more undervalued the stock is, it gets higher allocation in the final portfolio, right? With the position sizing algo we follow, again, what we have shown is the average allocation to a single stock, or the maximum allocation to a single stock, and the average allocation to the top 5 stocks, right? And you can clearly see, as you increase your portfolio size, your allocation to single stock goes down, right? Again, no surprises there, because the bigger your portfolio is, more are you spreading your allocations across more stocks, right? So your allocation, the top 5 stocks, or your maximum allocation, obviously that also goes down. Right? So essentially that reduces the chance of drawdowns, right? And you can see for a 30 to 45 stocks which we hold in MeritorQ, the allocation to a single stock has never exceeded more than 12%, as we've repeated in the past, and it has never exceeded 22% on an average for the top 5 positions, right? Again, this is over the backtest history from July 2006 to September 2022. Now, how does this translate to in terms of the actual drawdown, right? So again, what we are trying to show here is, 2 drawdown events over the last 16-year or the historical period. One is a global financial crisis, which is on the left, and your Corona crisis, which is on your right, right? And here you can see there's a good 5 to 7 percentage point difference, in the global financial crisis for the 30 to 40 stock portfolio. So 30 to 40 stock portfolio has a drawdown which is lower by 7 to 5% compared to the more concentrated options, right? Especially the 19 to 25 or the 13 to 18 stock portfolio, right? Even though during the Corona crisis the drawdowns were similar, at least during one major drawdown event, the 30 to 40 stock portfolio had a lower drawdown. Again, emphasizing the point which I made in the the previous slide, that one of the benefits of holding larger portfolio, apart from obviously that it's uniquely suited to the quant investing process, is that it reduces the chance of concentrated position either in a set of stocks or a single stock, and hence the risk of drawdowns. So I hope again I was able to convey the message that why a larger portfolio size is helpful in when you're investing in a quant context, and also why apart from the breadth, right, it also helps you in reducing your chance of drawdown, and also keep your turnover under control, right? So again, that's all from me for today. Over to you.
Thanks a lot, Krishnan. This is really useful. So before we move on to the Q&A, let me just quickly show you the demo, how one can subscribe to this portfolio. Krishnan, I'll just share my screen for a brief moment.
Sure.
Is my screen visible?
Yes.
Yeah, so for anyone who wishes to subscribe to this portfolio, you can visit our website, marcellus.in, and you go to this Invest Now option. Under the Invest Now option, you will click on the Investment Advisory Services. Once you click on Investment Advisory Services, it will take you to this next slide. So it will take you to the advisory page, which will look something like this. So you can download the product presentation from here. You can look at a quick infographic from Saurabh here to understand more about the strategies. And when you decide to invest in this, you click on this link, Start Investing. The Start Investing page will take you to this. And you click on Marcellus MeritorQ Fixed Fee Plan, which then takes you to this slide, which tells you about the current investment amount which you need to be investing here to start this portfolio. And then you click on Subscribe Now. Once you click on Subscribe Now, you will have to follow certain steps, starting with entering your email ID, then selecting a plan, filling in the billing information, paying the fees online, then signing the agreement via the Aadhaar OTP. And once this is completed, the portfolio will be visible to you on the screen, and you will be able to invest it there and then. Okay, one important announcement that I would like to make is, one second. Krishnan, you can share your screen.
Sure. Just give me a minute.
Yeah, so we have reduced the fees for this portfolio. Now the fees here is 2,500 per quarter. That is 10,000 rupees per annum, plus GST. Again, the recommended minimum amount for the investment is 10 lakhs rupees, but you can start with as low as rupees 2 lakhs and then gradually build your portfolio. You can also set up SIP once you have invested the initial 2 lakhs. For any more information, you can visit this link, masters.in MeritorQ Advisory, and you'll be able to get more information there. So let's move to the Q&A session. So Krishnan, I have got one very interesting question, considering the rally in the mid and small caps recently. So one gentleman is asking that, is there a case to rebalance the portfolio earlier than the stipulated time? So the rebalancing is due roughly 3 weeks from now. So what do you suggest here?
See, I mean, it's an interesting point, but again, I think it's also important that what we have seen is at least for people who have invested over at least for a 3-year or a 5-year investment horizon, and that's a minimum investment horizon for anyone investing in equity. Then again, rebalancing, whether I rebalance today or rebalance a month from now, it doesn't make a big difference, right? It's obviously markets are going through a phase, right? And again, for people who have been around, they would know that again the cycles are pretty common in markets. But again, the simple answer is I don't think we don't think it will make a big difference in terms of your returns, investor returns. As long as, like I said, right, we the most important thing is we stick to the rules, and this process works. Again, this whole construct, if you take this whole construct as it is, right, it's for some, for many people, again, they have difficulty in understanding why something so simple might work, but actually that's exactly the reason, right? Like we said earlier also, you might feel, again, rebalancing at a particular time, might give you advantage, but over a period of 3 to 5 years, I don't think it's a significant advantage, right? So maybe there are very extreme valuations where someone might say rebalance at a particular point, and look, I mean, we are also flexible on that. Maybe at a later point, where we feel where we have reached extreme valuations levels, where it's really prudent for us to, or an investor's best interest to rebalance, maybe out of turn. Maybe that's a call we will take in the future. But as of now, given where the current market is, I don't think we are at that point. So yes, we will stick with the, the announced schedule, with the first trading date of October end.
Thanks, Krishnan. So some questions on your specific slides. So slide number 9 shows that 19 to 25 stock portfolio generates returns similar to the 30 to 40 stock portfolio. So why not select a lesser number of stocks then?
Yeah. So again, this I emphasize this point, right? So this it's because of the risk-adjusted returns are better. And also see the turnover, right? The turnover also is slightly lower for a 30 to 40 stock portfolio because it is less concentrated, right? So that's the the reason why a 30 to 40 stock portfolio is a better choice. And also for the other reasons which we talked about, right? Because breadth is again the the strong point or an advantage for a quant strategy, right? So more number of stocks and the more frequently you rebalance, better it is. But like we said, again, going below 40 stocks is not recommended because it dilutes portfolio quality, and also rebalancing too often can lead to churn. So again, when you look at it both from a risk-adjusted return perspective, a turnover perspective, and also from the approach we are taking, a 30 to 40 stock portfolio makes the best sense.
Right. So one follow-up question on this. So why does the turnover decrease with the increase in the portfolio size?
Yeah. So the reason is the screening steps, right? So the very last portfolio which I talked about, again, is actually the screen universe, right? Which is a 90 stock portfolio, right? Roughly around 80 to 90 stocks. Average it comes around 90 stocks across time. So that is basically an outcome of your 3 screening steps which we have talked about. But what happens is that those screening steps don't lead to a lot of churn in the portfolio, right? Because like we have said before, our forensic screen or our debt to equity or even the cyclicality, these are essentially some very basic characteristics of companies. Generally, they don't move around that much, right? So the 90 stock portfolio, which is on the rightmost portfolio, has a turnover of 30%, right? So whereas all the other steps, essentially the turnover increase basically comes from the selection step, primarily the valuation bit, because the valuation is driven by prices, right? And prices are the most, I would say, the dynamic component in the selection process. So as you select a more concentrated portfolio, what that means is that selection causes that churn, right? And the churn therefore is more for a 13 to 18 stock portfolio, and it decreases gradually as you move to the screen universe, where essentially you are just screening on those 3 steps, and it's all fundamentals, right? Essentially on the company characteristics which don't change a lot, right? So as you move from left to right, we are going from a mix of evaluation based selection to just a portfolio just screened on fundamentals, right? Which is a low churn portfolio. Hence, as you go from left to right, your churn decreases.
On similar lines, so we say that this portfolio size will be between 30 and 40. But why can't it fix? Say, why can't we 35 or why can't we 30? Why it has to vary? And can the portfolio size go below 30 as well in few cases?
So on the first question, the portfolio size is a function of your opportunity set, right? So for example, if we find more undervalued stocks in a given rebalance, we might have a larger portfolio, in that particular rebalance, right? So it's basically a function of your portfolio size, and the selection is done such that, again, we are not going down or diluting the effectiveness of the selection process, right? So we're not going below the average stock, which is on valuation or profitability, right? So again, the whole selection process, we are not targeting a particular stock, right? So a particular number of stocks, but at the same time, we ensure that we select at least 30 stocks, but the range or the upper bound can be anywhere between 40 to 45, right? This is what we have seen, and like I said, not below 30. And not more than 40, 45. If you go, beyond that, again, you end up diluting the portfolio quality. And this 30 to 40 stocks then is, the band which we play with. And this is again a function of your opportunity set, right? So that's why we don't have a fixed number of stocks in the portfolio.
So you talk about diversification, but do we have any specific limits for individual stocks or say capitalization for any sector per se?
No, we don't, right? And the diversification again comes from the the large portfolio, right? This is what we have seen. And like I said, even with the position sizing, we assume we haven't seen more than 12% allocation to individual stocks at any rebalance, right? Over a 16-year period, right? Again, we have simulated this over over 32 rebalances, in history. So, but we haven't seen more than 12% allocation to single stock, right? So again, and the portfolio construct as such, the portfolio size as well as the rebalancing, that itself ensures diversification in the portfolio. And there's no cap on single stock. We didn't feel a need to have cap on single stock because precisely for the reason I mentioned to you. And nor do we have any cap on sector allocation, because the best stocks, right, which we want to select, which we want to have in the portfolio need not be from they need not come from all sectors, right? It could be that in a particular point in time you might have more undervalued or profitable stocks in one sector than the others, right? So that's the reason, because we want to have the best set of undervalued and profitable stocks, we haven't put any guardrails on single stock or either on the sector allocations.
Got it. So one question commonly we get asked is, suppose there are 40 stocks in the portfolio and maybe I don't like a couple of stocks from that portfolio. So is there a possibility that I can sell those 2 stocks and keep the rest of the portfolio?
Again, it's not recommended, and again, if you might do it, right? Again, we're not, no one is, because the stocks would be there in your demat account, so you might, if you want to do it, you still can, but it's not recommended for 2 reasons. One is, if you sell this, some of these stocks entirely, your next upcoming rebalancing might fail, right? Because the rebalancing would assume that you have these stocks still in your demat account, so it might potentially fail. And also, the other reason is this whole construct, right? This works well, when you follow again these rules and you keep the full portfolio as it is, right? Now, if you start picking and choosing stocks, from this, even if you can, what this means is, the results we have discussed and all the other, things we have discussed even today or even in the previous webinar, those will no longer hold, right? And the last thing you want is, from whatever discussions we have had, just by picking and choosing a few stocks, that you lose out on those benefits, right? And all the steps in MeritorQ, right? And this is the point, I've been trying to emphasize through our webinars and through our newsletters. It works all well together, right? The portfolio, should be seen as one unit, right? The rebalancing frequency, the portfolio size has all been decided, keeping, different things in mind, and all of them go well together. Now, if you start playing around with, with the stocks, or, the portfolio size, or even the rebalancing, etc., then obviously, like I said, right, your previous, whatever results we have discussed, those are no longer valid, and even the future returns are, or whatever benefits you might realize, they also become uncertain. So it's not recommended.
So there is one question on back-tested performance. Do we have some data against portfolios back-tested performance against Nifty Sensex during the past bear and bull markets? I think that breakdown slide of different years of returns might help.
Yeah, I don't have it with me today on this slide deck, but we can obviously get back to you with that data. But from what I can share with you is when we simulated this, and this goes back to the very first webinar on when we did this, when we introduced this product. And where we showed this annual return, essentially breaking up the return of the strategy, simulated strategy year by year over the last 16 years, comparing with Nifty 500. There were only 3 instances where the strategy has underperformed the benchmark, right? So 2022, it underperformed the benchmark. In 2019, if I'm not wrong, it underperformed the benchmark, and in 2007, it had underperformed the benchmark. So there were 3 years out of roughly 16 years when the strategy has underperformed the benchmark. Now, even if the question is on the drawdowns, in almost all major drawdowns, the strategy has had lower drawdowns versus the benchmark, roughly 5% lower than the benchmark. And also because of the value orientation, the strategy also recovers quickly, right? So even if it goes through the drawdown, it recovers quickly. So yeah, I mean, I don't know if it answered the question. And obviously, I don't know what we mean by bull side, bull phase, etc. But obviously, the strategy, like I said, right, if it has outperformed the benchmark in 13 out of the last 16 years, right? And whatever stats I'm giving you, this is from July 2006 to September 2022, before we launched this strategy. And obviously, again, we are not in the freedom to comment on, our live performance, but you can go and check on a small case on what's been the live performance from October till date.
Right. So there's one question on the structure, whether this is a PMS or mutual fund. I'll take that. This is a pre-designed portfolio available on small case. So it's neither a PMS nor a mutual fund. You can use your existing trading and demat account, log into the small case website, and you will be able to subscribe to this portfolio. Fee, as I already mentioned, it is 2,500 per quarter, irrespective of the amount that you invest in. The minimum investment amount is approximately 2 lakhs. There is no lock-in, no hurdle rate. The stocks remain in your account. You're free to exit at any point in time. This is confined to the Indian equity markets, listed Indian equity markets. So BSE 500 is the horizon that we are looking at. There are some questions around rebalancing. Will the rebalance happen automatically on small case? Rebalancing will have to be manually done. So we will publish the rebalancing update in October, first trading day of October, and you will have to visit your small case account and do the rebalancing manually. Krishnan, one client is asking about suggestions on SIP versus staggered lump sum investment. Any thoughts around this?
So, you have to make the minimum investment of 2 lakhs or the minimum investment which you see on the small case. But after that, yes, I would, it's highly recommended, if you want to go down the SIP route, it's highly recommended that you do. because a product like this, obviously you need to have patience, right? So, we have, repeatedly said you need to have at least a 3-year investment horizon, and investing regularly, over, as you earn, or whenever you have money, or whenever you save, that is a very good, approach as such. So yes, SIP is definitely recommended. Now versus lump sum, I would suggest SIP is better because obviously because it smooths out your investing, so that you're not trying to time your investment, and you're investing as you save, right? So if you are saving, say, some X amount every month, and obviously you have other revenues, you also consider to invest a bit in here in the small case.
Right. So it brings in some kind of discipline. If you go in for an SIP investment, it takes out the bias from your investing decision. So, more housekeeping question: can the NRIs invest in this? See, NRIs can invest provided their brokers allow it. So you will need to check with your broker whether they allow investing via small case. Secondly, you should be able to sign the agreement with the help of Aadhaar OTP. So if you have an Indian number and you can get an OTP for the Aadhaar sign up of the agreement, then you should be able to do it. And yes, the execution will happen from your end because this will be your own trading and demat account. All the buy and sell execution will happen from your account directly, and you will have to do it. Marcellus will not do it on your behalf. One question is on ticket size. So yes, the fixed fee of 10,000 is irrespective of the amount what you invest. So whether you invest the minimum of 2 lakhs, whether you invest 5 lakhs, or whether you invest 20 lakhs, this fixed fee remains the same. There are a few questions from existing subscribers, which are on the old fee regime. So our team will reach out to you. We are currently working out a solution to migrate all the existing clients on the old fee regime to the new fee regime. So our team will reach out to you in the next few days to help you get this migration done. Just give me 1 second. Yes, there will be reduction of the quarterly fee for the existing clients. As I mentioned, our team will reach out shortly to get this, to help you get this fees migrated. One more question on rebalancing. Again, it's on the ticket size. It is advisable to invest 10 lakhs at one go, considering the market is at the peak now. What's your thoughts there, Krishnan?
The same thing, which I said before. So if you have a concern on, whether a lump sum, is it's a long time to make a lump sum investment given where the markets are. So you can stagger it, right, over a period of time. Again, like it depends on, again, your own investment objectives. And SIP is a very good option. And in small case, again, a lot of these functionality is already built in, and it doesn't take time to put in a SIP option. Enter the SIP amount, and again, even the amount, I think, is can be it's automated, right? Alok, if I'm not wrong, the SIP option is automated. So
correct.
So all you need to do is just set up the process once, and to the extent that every month you get a notification, you just need to execute on that, and the SIP investment will happen automatically, right? So again, this is for someone who is too concerned on the where the markets are. But I would suggest, again, take a long-term view, right? This product is definitely not for someone who has less than 3 years of investing horizon, right? I'll keep on saying that, because again, all this timing, or where the market level, the questions on market level, they come from again, if you have a very short investment horizon, but over a longer investment horizon, it's of little concern, right? Because India is a growth country. There are a lot of opportunities, and Indian equities are in a very sweet place because India's economy is in a perfectly sweet place, right? So to the extent that you believe in the future of this country, and and you believe in the companies which are going to drive that future, so investing in public equities, and to the extent, again, given all the the other things which we have done here in MeritorQ, it should be a very good investment proposition, at least over a 3 to 5 year horizon.
Right. Again, a few housekeeping questions. Does small case works with all demat accounts? So I think small case has some 16 brokers registered with them. You can visit their website and you will be able to check whether your broker is listed with them or not. So they have all the leading brokers registered with them. So my assumption is that you should be able to invest. There are a couple of questions from the clients who are on Wealth Desk. So Wealth Desk is not accepting any new investments in Meritor, and we intend to migrate all Wealth Desk customers to small case going forward. I'm sure we should be able to reach out to you in the next few days and get this migration started. So once your migration is done, you will be able to rebalance your portfolio on small case. So we will reach out to you separately so that we can get this done. So I think these are the primary questions that we have. Yeah, one last one. So one more question that we get asked is, when we talk about quant, the first thought that comes to the mind is whether these are technical studies of the stocks, and whether we are looking at the price movements, volumes while making any decisions. I'm sure we are not, but your thoughts on this?
No, we are not. So there are obviously approaches where you're looking at something like that, but again, a good quant strategy again tries to use data from multiple sources, right? In MeritorQ, the only way price makes it into the final decision is through the valuation, and valuation again is really important in any investing, right? Whether it's public equities or investing in any asset class, valuation is really important. So that's the only point where price comes into the picture, right? Otherwise, it's completely based on fundamentals only, right? Again, this is especially the screening steps are completely fundamental based, and even the selection step where we are looking at both profitability also in conjunction with valuation. That is fundamentals only. So yeah, I mean it's nothing to do with at least in the current form MeritorQ. We don't use anything on momentum or volume, so on and so forth. Price is the only market input which enters in the portfolio construction.
I think we have run ahead of time. So with this, we will come to close to today's webinar. We hope that our clients and attendees were able to get some insights around why we have this 30 to 40 companies in the portfolio and how it helps having this diversification. If the clients have any further questions, they can drop us a line at help.i@marcellus.in or visit the FAQ section on our website. If they have any platform related queries, they can reach out to publisher.help@smallcase.com and they will be able to assist you. Once again, thank you for attending this session, and thank you, Krishnan. All of you have a great evening ahead.
Thank you.
Thank you.